Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Chad here, your hosts for this weekend show. This weekend show is going to be very much focused on commodities. The first half of the show, we're going to focus more on the metals sector. We're seeing breakouts in gold, the gold stocks, even silver and copper have been doing very well. Back half of the show going to be more in terms of the energy sector, oil and natural gas. Natural gas continuing to do well, oil maybe trying to find a bottom here. Within this whole show, we're also going to be tying in comments on companies where some of our guests and analysts see opportunities. Just as a reminder, everyone, please go back, visit our website, visit our podcast. Just search the KE Report in your podcast player and visit our YouTube channel, also our new Substack page to keep up to date with everything that we're doing. Please like, comment, and subscribe and share it with all of your friends. Without further ado, let's get into the metal side of this show, chatting with Joe Mazumdar. Joe is the editor of Exploration Insights. Joe, just as a broad comment, as I said on the intro there, gold breaking above 3,000. GDX recently broke to levels we haven't seen since 2012/2013. Silver is up over $34, and even copper ran to over $5. We seem to be seeing precious metals and commodities diverge from the broad averages. Joe, out of these breakouts that I just mentioned, which ones have your attention?
Well, thank you for that. I'm going to do a review of the 2024 results from producers, about 20 companies this weekend for subscribers. The cumulative market cap of these 20 companies would be like $225 billion. The top 8 companies that I'm looking at, mostly North American listed, produce about a third of the 2024 global gold production, about 68 million ounces. In 2024, like you said, gold price did really well, but the GDXJ lagged a bit. That's not the case in 2025, as we're seeing more leverage to the gold price right now, as people are talking about gold. Like I don't know about you, but when I look at ads now, a lot more ads are about gold. Even on the radio, people are talking about gold. And there's a bit of a divergence between people that are looking for gold just for gold as something to have, and that might not translate to equities. But there's this other part that, the uncertainty created by the current administration on potential recession fears have put a lot of institutional equity into big gold equities, which have done much better in 2025 than last year. And so in my review, I'm going to be looking at basically, how they've been doing in terms of margins, which have improved, in terms of balance sheet, which looks better, but then also which ones are lined up to grow through M&A. And I would probably stress this might be more the intermediates and hopefully coming down to single asset developers eventually.
Well, Joe, just to that last point you made about growth, that's been something we've been talking about a lot on the show for a while, that we're not seeing a lot of that in the majors, but the intermediates, the mid-tiers that you mentioned, they actually have the ability to actually grow on a percentage basis a little bit more by doing a bolt-on acquisition, an M&A deal, or bringing in a development project, just because they're smaller companies. How are you looking at growth in the majors versus growth in the intermediates?
So out of these 20 companies, what I did in terms of labeling growth, I said, well, we've got, measured and indicated resources that can be converted into reserves, and then you get inferred. So I assumed that the measured and indicated were being used to calculate reserves. And so in terms of growth metric, I took what I call total mineral inventory, which would be measured, indicated, and inferred, and took inferred over that total number. And the average of those 20 companies was about 27%, let's say 25 to 30% if you talked about growth. But there's a wide divergence in terms of growth. The bigger you are, the harder it is to show that kind of level of growth. And you're right, the intermediates coming off a smaller base can show more growth. But then also, as we look in terms of what they're doing with the extra cash that they're making, The bigger companies are issuing dividends, stable dividends, hopefully, and that will attract generalists. The intermediates are looking more for growth and merger of equals, like we just saw Equinox and Caliber, those kind of acquisitions to grow and get to that next level where you gain liquidity, lower your cost of capital. There might be more of that M&A coming up as well. But then I'm wanting to see if we start seeing some of these developers actually get acquired as well. We saw, Sabina get acquired by B2 several years ago. That was a challenging project to build. That might have dissuaded a few people from buying single asset developers, even though they were technically cheap. But I should think that with what's happening in the States and the ability to permit, people might look more into the States for M&A.
Joe, let's keep talking about this a little bit because it is one thing that I've been disappointed about is on the bigger end of these companies, production growth just is not there. It's flat, if not declining. And quite frankly, in the environment that we have right now, these companies should be producing more. They can take advantage of these higher gold prices. But I understand the argument that last major bull market, these companies grew for the sake of growth and the metals price turned around on them and they struggled. But without this growth, it's hard to say that these stocks are growth stocks. I mean, okay, maybe they're income stocks, but their dividends are still generally low. So then on the reserve side of things, don't these companies have projects in the background that they have written off in prior years that they could bring back into the mix and say, look, at least we're increasing our reserves? In essence, what I'm saying is, why isn't somebody shifting more to focusing on growth in this better pricing environment rather than simply consistently trying to cut costs, which is hurting their production growth?
So what I've seen is there's not a lot of reserve growth in the bigger companies and even some intermediates without M&A. They require the M&A to grow, especially on the reserve side, but also in some of these guys in the total mineral inventory. They're not technically growing, and that might be due to the lack of exploration, and they basically cut exploration out maybe, and now they're just looking at growth through M&A because it might be cheaper. Yeah, like I did a bit of a metric on proportion of revenue spent on G&A, exploration, and finance, and the average on the proportion of revenue for G&A was about 3%, and that was about the same as for exploration. So on average, these 20 companies that I looked at are spending 3% of their revenue on exploration. Some of them are not spending any on exploration, which suggests that they're only looking to grow through M&A. And there's more than one of those sort of companies. Like Pan American Silver would be one of those sort of style of companies that's more into M&A than they are into exploration. So I think some of this is due to the lack of exploration. That's also why we see more of this industry funding the juniors, and that's their form of exploration, that they fund juniors to explore. The juniors do it. It's cheaper for the major. They don't have to bring on anybody. And if they like it, they eventually acquire it, but technically they're following the project and helping them progress. So that's another form of growing through exploration, but not technically doing exploration internally.
Well, Joe, I'm glad you went there because that's exactly where I was going to ask you is the strategic positions we've seen from larger companies into the juniors to back their exploration programs and let the juniors be the exploration workhorse. There's a lot of nuance around this. I'd love to get your thoughts on. There's some companies that have taken out a position through only equity, and there's other ones that take it over on a project level where they're getting an earn-in and a joint venture agreement or an option agreement. And then there's some companies that continually participate, but there's other companies waving the flag that a major's invested with them, but they haven't done anything for 6 years or 8 years. So how do you look at strategic investments from the producers into the juniors?
It's an excellent question, and it's very complicated. I used to work in corporate development for Newmont. So one thing that I look at when somebody has an equity stake, the first thing I look at was how they actually got that equity stake. Because sometimes what happens with an equity stake is it's you bought the project off of a major, you couldn't pay them cash, and so they ended up with an equity stake. And so for me, that's like a passive stake that might be an overhang. So once I eliminate that, that's good. I want proactive investment. And it's nice that they have, whatever, 9.9 or 19.9, which would be, great in one sense, but also bad in terms of, potential M&A. There, you might only have a single bidder. So there is that other part of it. The problem with the equity stake when you're dealing with like a big project that requires a lot of expenditures, once industry, takes that 9.9 or 19.9%, and they're a bit handcuffed in terms of what they can do going forward, they've given you whatever it was out of your company. Maybe it was only 3 or 4 million for that 9.9%, but you've got this big copper exploration program and you've already spent their money. And now, yes, you own 100% of your project, but you've got to constantly go back to the equity markets. And if you don't hit that good hole within 12 to 18 months, you might be raising at a lower price. So, if you find a project that's 25% of what a major copper project looks like, that's quite a significant deposit, and if you're only trading at 20 or $30 million market cap, it might be a better to do it at the project level than do it at the equity level, especially for projects that require a lot of funding over a long term. I prefer the project level. I prefer an earn in that way because retail markets can be fickle. And if you don't get that drill hole that the market's like within the 12 to 18 months, and maybe you get that nice alteration hole that looks like you're close to something, the major realizes that and they continue to fund you, whereas retail might not continue to fund you on that result because technically they don't get it. So for those sort of things, I prefer that the investor has the same wave as the actual exploration program. And that wave is a long wave. And so you need long wave money. You can't have short-term wave money. That's why, we're constantly diluting these juniors and, they blow their share structure out.
Oh, we've seen that in so many different companies. But unfortunately, exploration is expensive, time consuming, and that just leads to blown out share structures. But having those partners does help. So, Joe, with this research that you've done that I know you're sharing with your subscribers, I think shortly after this interview will go live on the weekend, there any companies that are standing out to you that are offering some growth, that have some good growth profiles? It's personally something that I'm looking for. I want companies that can take advantage of these higher metals prices right now because everybody benefits from the higher metals prices, but I want to see some growth in the sector. So, do you have any companies you can share with me that you think are on that growth path that could satisfy what I'm looking for?
Well, when I did this, I was more interested probably from the take on M&A, like who would go acquire the companies that I have in my portfolio. Because the letter is Exploration Insight, so we deal more with the juniors than the majors in terms of saying, oh, hey, I really like, whatever, Agnico Eagle or something like that. What has been strange, I will note, is that usually when the gold price goes up, it's the leverage is usually provided by those companies that are on the cusp, that have very low margins under lower prices, but their margin expands on a percentage basis significantly when the gold price moves because they're more of the higher cost companies, like your Equinox, let's say. But what I've noticed, like last year, Lundin Gold did ridiculously well. That was one of the better ones. They went up 70%, and they're already low cost. They generate a lot of free cash flow. They paid off their debt. They're doing everything right, and ridiculously, the market's rewarding them. And usually the market doesn't reward people that well for doing everything right. So that surprised me. Another one that did quite well and low cost that's growing and found some, and developing a new project in Serbia, I would put Dundee Precious Metals, and they're doing well. And then the market is rewarding them as well. They're low cost, higher grade, they deal with more complex metallurgy, but yeah, they've done quite well. But even with the increase in the gold price and the buoyancy of 2024, still it could be problematic. Like the issues with West Africa and Mali really hit Barrick, and also hit B2 Gold, as well as their issues with the developing Goose, which I think is now coming into commercial production. I think they're organizing a site visit and announcing the commercial production on that one. So even with the gold price rise, it doesn't necessarily float all boats if you're dealing with capital escalation or a geopolitical risk.
Well, Joe, let's talk a little bit more about geopolitical risk or the lack thereof. There's different jurisdictions that have people's interest, but you mentioned at the onset that the U.S. may become a better jurisdiction than previous just because the idea being the red tape being removed, that less restriction, faster permitting, maybe more government support on getting these projects built. When you look across, and we can open it up to other metals, whether it's gold or silver or copper, how are you looking at the U.S. as a jurisdiction in light of maybe reduced restrictions?
Okay, so there's a few things about the US. So I would say one thing, yes, on the permitting, I don't think there'll be a lot of NGOs coming in at the last minute and trying to scudder things. And maybe they get less weight because it seemed to me that under the Biden administration, they sort of rolled over for some of these NGOs. I don't think that would happen under this administration. But that doesn't mean that the NGOs still won't slow things down. They might not get them revoked like they did with the road for Trilogy. When they had the permit, then they took the permit away. But they might still slow down the process. But what I would say, another factor in the US is because they're like reducing the government employees, some of that has hit the permitting of ground on BLM or US Forestry Service. So just permitting drill programs because there's less people to talk to and you don't know who to talk to, and there's less people that are, dealing with more permits. So it's not all great in terms of that. And another thing I'd point out is that, the cost of drilling in the States has, especially in the West, has gone up quite a bit. So when I was there maybe a year ago, it was $450 US per meter. We're not talking about helicopters, we're talking about road access, not complicated logistics. But that 450 is probably more like $500 a meter for core, which is not cheap. And it's not only labor, it's piping, it's a whole bunch of things. And so that's a little bit of an anomaly. And so I think a lot more people in the West are going to be doing reverse circulation now until they find something and they can get a bigger equity raise to drill diamond. But I've seen, some of these companies that are dealing with critical minerals, even in the States, that, are having a hard time getting funded. And some of the problem here is bang for buck, because logistically, some of these companies that require 800, 1,000 plus dollars per meter to drill, the investors look at them and go, well, now you've only got money for a 3,000 meter program and that's not a lot of news flow. And if you miss, you're going to be back here asking for another 3 to 5 million just to drill another 1,500, 2,000 meters, and this is going to take forever. And your window is very short. And so there is a bit of that as well. And then the other leading, I would say, is that the delta between critical and security, which we might have discussed before, is, they're not about energy transition metals. That's not their focus. Their focus is on security minerals that they could see themselves having an issue with. And that would be antimony, rare earths. Now they're trying to protect their steel and aluminum industry. They're trying to protect copper. And so if you could produce that domestically, that's important. But if anybody knows anything about the soup to nuts in this, is that there's still a processing gap in the States in terms of copper smelters, aluminum smelters, what have you. And so even though even if they find a mine, like a copper mine, if that copper mine is producing concentrate, the chances it's going to get smelted in the States is very low. So it's got to be sent overseas. And as we know, 50% of the smelting capacity is in China. So there's where you get a little bit of an advantage for some companies, like I would specifically say like a company like Arizona Sonora Copper in Arizona, developing the Cactus Park Salia project, which they switched from mostly underground to open pit, lowered the grade somewhat, but that's all solvent extraction electrowinning on oxide and enriched material that would get them cathode and not copper concentrate. So that cathode would go straight into the market, straight into copper rod manufacturing, copper wire, right into the cars that they're manufacturing in the States. So you got to still be a little bit nuanced in terms of how you make your selections here in the current environment.
That's very interesting, Joe, because I have noticed a lot of US focused copper plays doing better. And a lot of it does seem to be on that whole more positive outlook for permitting. But what you're saying here is don't just go blindly into any US copper play. It needs to be unique because of that whole refining aspect. Can you give us just a little bit more info on this and why maybe some of these other copper plays just don't at least make sense in the here and now environment?
Yeah, the problem with a lot of these big copper projects, which are attractive in terms of, pounds, billions of pounds, let's say 20 to 30-year mine life, let's say, they cost a lot. The capital intensity of a lot of these projects is very high. And it could be like you can have lower labor in some of these Andean projects, but logistically, you're up to 5,000, 4,000, 5,000 meters. There's not a lot of infrastructure, and so the capital intensity is quite high. And that's some of what they dealt with at Quebrada Blanca too. And that's got a lot of people scared. And so even though the copper price is going up more so probably because of the potential imposition of tariffs on copper imports into the States and potential implications for the global economy. But still, I would say that developers, producers, anybody looking to build a project needs a higher copper price to incentivize them to build in this environment of higher input costs because it's harder for them to get cheaper Chinese goods now. And so they're going to have to pay for more expensive goods from potential Western supply chains, which might not come at the same speed and be more expensive. And also, the quality of the Chinese stuff has come up quite a bit in the last 2 decades. So it might be the Western stuff that might be, a worse quality now than the Chinese stuff. So, so that capital intensity is an issue everywhere, and especially in industrial metals like copper. And you do need a higher price to incentivize people to build. But the people that are already producing, the people that have lower cost production projects potentially that make sense, those people can take advantage of this market. And with Arizona Sonora, just getting back to that one, that's probably the window that High Bay Minerals looked at because they're already in Arizona building their project Copper World, which looks very similar to Cactus Park Salyer, and they want to eventually produce copper cathode as well. But their way of producing copper cathode is basically leaching the copper concentrate, and fine grinding it, ultra fine grinding it to leach it to produce copper cathode. Arizona Sonora metallurgically is not that complicated.
Well, Joe, just to that point, you mentioned to us off mic that you think this HUD Bay positioning in Arizona Sonora, and we've had the company on the show a number of times, so I think our audience is up to speed on it. But you think it's more significant even than the Newton technology, just from the standpoint of kind of a vote of confidence and a vetting by HUD Bay. Maybe unpack that a little bit more on this particular company.
Okay, so I think there's a few things. So when Newton came in, it was good because this was, a microcap story, had a Rio Tinto subsidiary that was putting their stamp of approval on the project. But when Newton comes in, their stamp of approval is not really a stamp of approval on development, permitting, all of that. It's more about stamp of approval to say, you know what, I think your copper mineralization would work well with our technology, which is, basically some, bio-ox on the copper. And, they need a certain amount of sulfides, mostly pyrite, to keep the bugs happy. And it doesn't work for every deposit, but, their incentive is to give you money to test your product, which is your mineralization, your resource, to see if it works. But the way the deal was structured, they came in with equity, which was great. It was like at market premium, whatever. And then you get a big name into a company in terms of a junior. But HUD Bay is more important because they're developers and producers, and they're already building a project in Arizona. So to have their stamp of approval is even more important. And also because Newton, their technology was going to be working on the sulfides. And the sulfides right now, in terms of Arizona Sonora Park Salyer project, are not coming in anytime soon in terms of the mine life. And so their impact on the net present value of that project is much less because by the time they bring in the sulfides, it might be year 10 plus, and that dollar is worth 50 cents. And so their impact on the overall project, the IRR and payback will be insignificant. But if you get somebody like Hud Bay coming in, cost of capital will be much reduced, potential synergies between the two projects. I think that looks like a better fit in terms of being more important with respect to private placements and stamps of approval.
That's so interesting, Joe. And what do you think of these new technologies? It does seem like there are some majors out there developing some technologies. I want to get your opinion on the balance between these technologies either improving economics at potential new mines, or what I'm hearing a lot of too is that these technologies can extend mine lives. We keep hearing about how some of these major copper mines are nearing the end of their mine lives, and that's where we're going to see this big shortfall. Where do you see these new technologies playing the biggest role in the copper space?
So, electrification's a big one in terms of trucks and remote underground. That's another one where they have technology that will give you communication way deep underground. And so when we talk about remote, we're not talking about a remote operator that's maybe 50 meters, 100 meters from the actual machine. They're they're like a kilometer up at surface operating it, like they're online. And so productivity increases. You need less, there's less issues about diesel and that underground because there's no humans down there. So that's another technology in terms of, a productivity increase. There's metallurgy is a big one because we've taken a lot of rock above the ground and call it waste or low grade stockpile. But some of these things have elements in them that suddenly, with the Chinese bans on some metals, they might have them there. And so you could see some of that happening in Zambia as people are looking at the old tailings and seeing if they can get gallium and germanium out of those because they're already, milled and fine grained and see if they can extract those. So people are looking at what they can do with what's already up there as well. But when you develop bigger and bigger open pits that go deeper and deeper, like when I was with Phelps Dodge, this was a while ago, but things people don't think about, like high angle conveyors. And those things were very important back then, more than 20 years ago, because they reduced the amount of trucks going down the pit because those trucks, as the pit got deeper, would take hours to get to the top. And so if you had a high angle conveyor that could take, stuff from the pits and then right to the surface, that was going to be faster and already reduce your diesel consumption. And so those sort of things are the things that we don't hear about or, normally because that's where the big companies are spending a lot of their money. They've got an active operation, it's going deeper, or they have issues with diesel underground. They have to build a new ventilation shaft that might, be 1.5 kilometers. But hey, why don't we do it remote and we won't have to worry about, the diesel particulate matter underground because there won't be any people down there.
Yeah, it's going to be interesting to see how these technologies are used to advance projects that maybe weren't economic before, but could be now, or extend mine life, to Corey's point, or just improve processing recoveries. A lot going on. It's nice to see some innovation in the mining sector. You brought up an interesting point there, though, Joe, about some of these co-credit metals. We hear a lot about this, and we could broaden this discussion to copper companies that have a gold kicker, or gold companies with a copper kicker, silver companies that have a copper kicker, or some of these specialty metals like antimony is red hot right now, and tungsten. And if you're a gold project that has antimony, you get that double whammy. How do you look at that, or how do you value companies that are a primary metal but then touting their co-credits?
Well, I would say that a lot more companies that I have are talking about antimony, and some of them that I never knew had antimony, and probably they didn't know either. And what the idea is, like antimony is another one of these security minerals because China has banned the export of it. So it becomes a security mineral for the US, and suddenly there's funding for it. and people are interested. And so it's not only funding, but it could be permitting. So I own one in Australia called Southern Cross Gold. It's now dual listed. It's in Victoria. It's a Fosterville-like mineralization, gold and antimony, and everybody knew the antimony was there. That wasn't a surprise. But in terms of the majority of the revenue, 80% in situ, will still be gold, but that 20% of antimony will help them permit the project. So it's more about that with some of these projects. It's not about, hey, we're going to make a lot of money off the antimony. Sometimes it's just about getting through a lot of the permitting red tape. It's easier once you're on that list of projects that they prioritize because of the metals you're going to produce. It's a similar sort of thing with Perpetua and their project in Idaho. Even though antimony might be 10% of the life of mine revenue or institute revenue, they were going to get more than they needed in terms of their upfront capital from their funding from government agencies for that 10%, because that 10% was volumetrically very important amount of antimony that would feed the local market. But then we get into the processing side. Where is that antimony actually going to be processed? So that's another issue. But right now, yeah, things like antimony, they're important, I think, in terms of being permitted, maybe getting a little bit lower cost of capital. But still, I prefer that most of the revenue is made from a bigger metal, more liquid metal like gold, as opposed to it just being like an antimony project.
Yeah, I think you're right on that, Joe. But boy, oh boy, we're hearing everybody seems to have antimony right now, and then they are a lot tying it into permitting mostly, and then also throwing around the idea of potential government funding too. We'll see how this all leads. I find permitting news and government funding, both of those for me is a more show me rather than tell me
But
type of
I would
mood.
just add, on the funding part, what I'd be interested to see is what happens with the Department of Energy, Department of Defense, Export-Import banks, any government agency in the States, are they willing to fund outside the States like they were previously? Like, will companies in Canada see that money anymore? I don't know, pre or post annexation by the US. Or, will companies in Australia see that money anymore? Or will it all just be internal? That would be another point that I would watch for.
Okay. Hey, Joe, thank you very much for sharing your insights here. We're out of time for the weekend show, but I recommend everybody clicking the link in the show notes on our podcast or YouTube page to go visit the Exploration Insights website and even look over that recent report that Joe is about to release on 2024 gold company updates in terms of growth, cash flow, all those major fundamentals that we should be paying attention to. Again, Joe Mazumdar, editor of Exploration Insights. Great having you on the show, Joe. Thank you very much for your time today.
Great. Thanks a lot, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back to the weekend edition of the KE Report. Now switching our focus over to the energy sector, chatting with Dan Steffens. Dan is the president of the Energy Prospectus Group. We're going to talk nat gas pricing continues to remain strong. Oil can't really seem to get back above that $70 a barrel level, and some of the stocks that Dan thinks can especially take advantage of this higher natural gas price. So Dan, let's start off with natural gas pricing. It's doing very well. It's holding over $4. Quite frankly, we hear so much about how weather impacts the natural gas price, but one thing we chat a lot with you about are inventories, storage, what we're seeing in the market, and we've been hearing from you pretty consistently that storage of natural gas has been relatively low. Let's start there. Dan, what are we seeing on the more fundamental side in terms of what's available to the U.S. here? Inventory levels, please.
Well, the fact that gas is holding above 4 I mean, there is currently, as of today, and as of the second quarter of this year, once we get into the spring, demand for natural gas for space heating goes down. So this is when you're going to have the lowest prices, and it's before gas demand for power generation really ramps up in the South for electricity generation. So this is when you should have the lowest gas prices of the year. So, but refilling storage is not an option. So we've had a much, much colder, January and February than we had the last two winters. That has drained U.S. storage below the 5-year average. It's more than 10% below the 5-year average. As of last week's report, I think this was as of March 10th. Now, let's see, maybe March 7th even. As of March 7th, there was 230 BCF below average. I know that's just a number, but that's a big deal. But the inventories were 628 BCF below where they were last year. So when we ended the last winter, we had over 600, and I think it was really close to 700 BCF below the 5-year average at the end of the winter. And so we were already, halfway full before. So it was really easy to refill storage. Well, this year, if you're 230 BCF below, that's almost a trillion cubic foot difference year over year. And refilling U.S. storage before the next winter arrives is not optional. It has to be done. The utilities that bring natural gas to our homes and businesses in the large cities around the United States are required by law to have an amount of gas in storage to meet demand for a cold winter. Okay. So they will pay any price to refill that. So, and also these big LNG exporters along the Gulf Coast, they have contractual obligations to meet the demand of the people that helped build their big facilities. So this situation, and it wasn't this severe in August of 2022. If you pull up a natural gas chart, you'll see that gas spikes to over $9.30 per MMBTU in August of 2022, and it was not as tight. The market was not as tight as it is today. So I think when we get in halfway through the summer, halfway through the third quarter, and it looks like we're not going to be able to refill storage, you'll get a bidding war between the LNG exporters and the utilities that bring gas to our homes in the market, and they will pay whatever it takes to get that gas supply.
Well, Dan, let's talk a little bit more about these LNG terminals. We've talked about it in the past, but we're getting closer to where some of these other new designs are coming online in the U.S. and even the first one in Canada. And then there's also the added component to the LNG demand side of more power centers as coal power is replaced, and also as AI data centers look to get transition power. Maybe they're going towards nuclear, but those are still 5-10 years away. So in the interim, nat gas is going to be the electrical power hub growth in the U.S. and abroad. How does that all factor into the demand side?
Yeah, I mean, I saw an article the other day that said at ERCOT, which is the outfit that controls our electric power grid down here, they were saying they don't think they can shut down. There was 3 or 4 coal-fired power plants that were supposed to be shut down this year, and they don't think they can do it. They don't think they can do it and meet electricity demand. They're building some of these AI data centers in Texas. Anyway, so it's a big deal. But on the LNG export facility, there's 2 things that combine that we have 5 billion cubic foot per day more demand for gas just because of the LNG export facilities. So 3 new facilities came online in 2024, in the second half of 2024, that added 3.3 billion cubic feet per day of additional export capacity. And the last 2 of those facilities, Plaquemines and Train 3 down to Corpus Christi, are just now ramping up to their design capacity. So we're not even there yet. And every week we're seeing new records set for LNG exports out of the U.S. Then also Freeport, a 2 BCF a day facility, was offline for almost from like November of 23 through June or something. It was like offline for 8 or 9 months because of a fire. They had a fire, it shut down the whole thing. And then even when they said they were ready to bring it back online, the government, had to have all these inspections and all this stuff before they could ramp it up. So now it's fully back online, and that's another 2 BCF a day. There's an Exxon facility, it's called Golden Pass. And that actually completion of that facility has taken longer because they don't have enough workers. Because the workers that do all the welding and everything on the new facilities at Plaquemines and Corpus Christi, there weren't enough other ones to finish their deal. So Golden Pass train number 1 is supposed to add 700 MCF per day of gas in the fourth quarter of this year. And then train 2 and 3 is going to be completed in 2026. But anyway, so by the fourth quarter of 2025, the U.S. will have 22 BCF per day of LNG export facility when it just had like 14 and a half BCF per day, back in 2023. So it's really ramped up quickly. And then Trump's team is going to fast track the approval of several more LNG export facilities that should all be online by the end of 2028. So we're going from 14 BCF a day to 33 BCF a day of export capacity. So just that alone, and then you add that with the weather situation we had this winter, and you've got a very, very tight U.S. natural gas market in the second half of this year and through all the way through 2026. The other thing is, a lot of people hear about these AI data centers. Well, really, of the stuff we've talked about, that's the smallest impact. But I get a lot of calls about, oh, aren't they going to need all this electricity? And that is true. They're going to need a lot of electricity, and the only near-term solution is to build natural gas-fired power plants that are dedicated to the individual AI data centers. And a lot of those are under construction right now. I follow a company that is building them for some of them, and it's a pretty big deal.
I am so interested to see how these data centers get powered, and it does seem like a lot of it will be natural gas, at least early on. But Dan, regarding this export capacity, look, it is going to explode, as you outlined, over the next about 5 years. Now, from my understanding, this is important because outside of the US, it seems like everybody, especially in Europe, pay a lot more for their natural gas. So that would entice the US producers to export their capacity. Can you break down the pricing model, though, of how this will work? How much cost does it add to these producers to get their products overseas? And have we seen this in history before, where export capacity grows, and does it have to correlate to higher prices?
Yeah, well, okay, it takes about $2.50 per MMBTU to freeze the gas, basically not freeze it all the way, but liquefy it. You have to get it to about 250 degrees Fahrenheit below zero, which I frankly don't know how in the hell they do that, but they do. And then that includes the transportation cost to get it to Europe. So maybe you can get it to Europe for 250 and takes you $3 to get it to Asia. But the Europe and Asia gas prices today are $13 or $14. So you take $4, say you add $3 of additional cost, you got $7. The profit margin is 50%. So the profit margin is $7, $7, $8 sometime on this gas. And then, natural gas prices in Europe and Asia went into like hyperspace a few years ago when the Russian thing cut off their gas supply, and it was, they were paying $20, $30 an MMBTU for gas. So the profit margin is gigantic. Now, who gets that profit is split between the producers themselves. They get higher gas prices because they increase the demand, but also a lot of times it depends on where the title to the gas shifts. And a lot of it actually goes to the companies that own the ships that transport it. So there's a lot of profit there for them. But, the whole food chain of getting that LNG, to the big markets in Asia and Europe is sharing some very big numbers. And, I think there's no end in sight. Maybe at some point, we overbuild all this LNG export capacity and the price comes down, but it's still going to be profitable. They're not going to shut down. But let's say that natural gas price in the US has to get so high that it makes the LNG exporters not export that gas. Well, that number is going to be like $9 or $10 an MMBTU. And that's why in August of 2022, we saw the gas price spike to over $9 because that price was needed to slow down LNG export facilities so we had enough gas and in the third quarter to refill our storage before the next winter happened. It's all about refilling storage before the next winter arrives.
Well, Dan, in lieu of all this export capacity that the U.S. has, and again, Canada's going to get started as well, and because natural gas is so regionally priced, I mean, even in this country, in the U.S., there's different pockets of what nat gas prices go for. But when you look globally, it's a big dispersion of pricing. Do you think this normalizes the nat gas pricing environment on a global scene a little bit more than we've seen in history? Because eventually Europe and Asia's prices will come down as the U.S. and Canada and North American supplies go up. Will this normalize nat gas pricing?
Yeah, but if it normalizes them, it's going to be like $5 or $6 an MCF. It's going to be an extremely profitable price for our upstream companies. Now, yeah, you're absolutely right. It's regional. It's even sub-regional within the U.S. I mean, even during those winters that were warm, the previous two winters that were warm in the eastern United States, natural gas in the Western market, the market, supplying, the West Coast, big West Coast cities and Salt Lake City and all that, those gas prices stayed at $8 or $9 an MMBTU during those winters because they were running short. And that really helped the Canadian, gas producers that could get their gas down into the pipes that service the Western US. So it's even sub-regional. When I was at Hess, we actually sold our gas into the New York market at $60 an MMBTU for a few months in a really cold winter, 25 years ago. So gas prices have been very high. And when you look at it on an energy content, where could the gas price go? And this is why gas prices are so much higher in US and Asia. In those markets, gas is priced based on its energy content. So it takes 6 MMBTU of natural gas to equal the energy that's in 1 barrel of oil. So if the price of oil is $60, the natural gas price should be $10, 1/6 that price. But now you subtract transportation and all the other stuff in it. I think the upside for US natural gas and eventually Canadian natural gas is 1/10 to 1/12 the price of oil. So just tell me but let's say oil goes to $70 in the US. I could see the natural gas price being in the $6 to $7 range if it's priced on energy content. And I actually went to a conference and there was guys from API talking about, when the LNG ramps up, because if we do, and think about it, when we get to, US gets to 33 BCF per day of export capacity, man, that's a big chunk of our gas now. So the global oil and gas price will set the domestic price. It'll be lower domestically, but it'll still go toward the global price of gas, less transportation and processing to get it there. So I think 1/10 to 1/12 the price of oil is a reasonable but that'll probably happen in like 2028 or 2030. So who knows? But I can tell you, it's a lot higher than where gas has been trading for the last couple of years. And all of our upstream companies that I follow, if you just put $4 gas in their future price forecast or their income forecast, it's incredible how much more profitable these companies are. Because the lifting costs, their processing and lifting costs for a lot of the big ones is only like $1, $1.25. They have huge profit margins at $4 gas.
Okay, Dan, let's get into the stocks then, because look, if the outlook for natural gas pricing is that strong, it does seem like it'll bring up costs for the U.S. citizen, but let's just talk pricing here and the stocks. Last year, natural gas didn't really get above $3 until Q4. It briefly touched there in May and June, but in 2025, nat gas, from what I'm seeing, hasn't gotten below $3. So totally different pricing environment. Have the stocks reacted the way you would expect?
Yeah, I was using $3 gas when I first started doing my 2025 forecast, at the end of 2024. I was assuming we'd be at like $3 gas in the first quarter. It'd go to like 2.75 and then ramp up to 3 in the third quarter and maybe 3.50 in the fourth quarter. So it's way above where I started. I have just twice raised the gas price that I'm using in all my forecast models. And right now I'm using, 350 for the first quarter, and it looks like the price is going to exceed that. I'm using 375 for the second quarter, and right now all the futures contracts for the second quarter are above four. So that, and I'm 425 in the third quarter and 450 in the fourth quarter. And then I'm still using $4 gas for all of 2026, but I could definitely see a scenario where it goes above $5. But I can tell you again, if it's $4, these gas companies, the big gas producers, are going to make a lot of money in the next, year and a half for sure.
Well, Dan, you've mentioned it's really crucial for investors to dig into the energy companies in their portfolios or on their watch lists and look at the energy mix, like how much of it is oil, how much of it's natural gas liquids, and how much of it's actually dry natural gas. Maybe speak to how you're looking at companies, and do you like a heavier weighting to natural gas right now in the mix just because of the pricing differential between nat gas and oil?
Yeah, like right now when our members call me and if you could only buy a couple stocks, what would they be? And I said, well, I'm very bullish on natural gas, so I'd just be buying the big natural gas producers. And it's like all of our Sweet 16, which is my top picks, they all produce a lot of natural gas. All 16 companies, I think the lowest amount of if you add natural gas and natural gas liquids and price it on an energy content, or it looks like the lowest amount of production is 30%. I mean, it's probably, of the 16 companies, 8 of them are over 50% of their production on a energy content level is natural gas and NGLs. And then there's several that are, it's way up there. Like EQT is like 99% natural gas and natural gas liquids.
So, Dan, back to my question then. Have we seen these natural gas stocks react? I see some of them are doing well, but have they been providing that torque to the underlying price? And where do you look to? What stocks do you like?
Yeah, and they've come up. I mean, we're not the only people that see this. I mean, this is why if you look at the futures market right now, just Google natural gas futures on the NYMEX deal, and you'll see that the futures prices for December and January, December 25 and January 2026, are already above $5. So they can lock in that price right now just by going to the futures market. So, and it's also extremely important to know where the company's gas comes from. The Permian Basin, I want to own these Permian Basin, but the Permian Basin is an oil basin. The wells out there are drilled for oil. And the producers out there, for them, natural gas is just a byproduct that they have to get rid of. And because there's not enough pipeline takeaway capacity to West Texas and Southeast New Mexico, they get very low gas prices. Like, I mean, they're only getting $1.50 for their gas. So it doesn't matter how much they produce if they can't get it to a pipeline, that can't get a different price. They have some of them, actually, some of the smaller companies have to pay people to take their gas because they don't have good marketing people. But so the 4 companies that I really like, my top picks, and they are all producers in Appalachia. By Appalachia, I mean the Marcellus and Utica shales, where they're getting most of their gas. And it's the biggest state is Pennsylvania. So western and northern Pennsylvania has a lot of gas. Ohio and West Virginia is where they're getting their production come. And those 4 companies in our Sweet 16 are Antero Resources, and they have a fantastic marketing company, and they can sell about 70% of their gas today is being sold into an area in the Louisiana Gulf Coast called Tier 1 that actually pays premium prices. So they get about 30 cents an MMBTU higher for their gas than the Henry Hub gas price that you see in the news every day. And then I also like Range Resources, which is with a symbol RRC. Antero is AR. RRC, they were actually credited with discovery of how to do horizontal wells in the Marcellus Shale, and they hold about 1 million acres of really tier 1 leases. It's almost all of it's held by production, but they have literally thousands. I think they have about 3,000 development drilling locations that are extremely profitable at $3 gas. They've been profitable through this whole thing, and they've been able to maintain their dividends. Even when gas was $2, $2.50, they were able to maintain their dividends and be very cash flow positive during the last 2 years. So then the other one is EQT. Of course, EQT is the second largest gas producer. It's EQT Corp and symbol EQT, and it is the second largest producer of natural gas in the U.S. The largest is, I think it's Extra Energy or something. It's the merger of Chesapeake and Southwestern created a new company, and that merger made them the number one gas producer. But I don't recommend that one, mainly because it has so much Wall Street coverage. It's probably already priced fairly. But if you want to own number one, they're the one to own. And then the other one I like up there is Coterra. Now, Coterra production is about 30% oil, crude oil, and 70% NGLs, or NGLs and natural gas. It pays a nice dividend. I like it. The only company in our Sweet 16 that does not pay a dividend is AR, because they are more focused on, building reserves and getting more market share and everything. So they're doing well. Now, the other areas that can get gas to the Gulf Coast exporters and get premium pricing is the ones in the Eagle Ford. In South Texas, they're closer to the Gulf Coast, and they have enough pipeline capacity. They have excess pipeline capacity, so they get good pricing for their gas. And the number one company I like down there, they are I think the third highest producer. The name of the company is Crescent Energy. It's CRGY. And I like it because it's kind of off the radar screen. It's smaller than the other companies, and it is going to report a big increase in production from the fourth quarter to the first quarter because of some acquisitions and mergers that they've just recently completed. And then now the Haynesville is really close. The thing is with the Haynesville, those are deeper wells. The Haynesville wells come on very strong. They pay out quickly. At $3 gas, they're very profitable wells. And Comstock Resources, I like CRK, except that it's owned by Jerry Jones, controlled. He owns 85% of the stock, and it's controlled by Jerry Jones, and it gets a lot of publicity. So yeah, if you think gas is going to go to $8 or $9, it's going to make a ton of money. But I think if gas just stays in the 450 range or so, it's probably fairly priced already. So I like the other ones better. Let's just say that.
Well, Dan, I appreciate you breaking down a lot of the different gas companies that have your attention. And yeah, that Comstock does get a premium because of Jerry being involved. But thank you for outlining those companies for our listeners. Let's widen the scope of the conversation out, though, to talk about the impact of tariffs. It seems like that's all we hear about today is, which tariffs are going to stick, which ones are going to maybe be used as a bargaining chip. When it comes to the energy sector and the tariffs on Canada, it does seem like those are potential effectors of price in the near term. How are you looking at that? And let's widen the scope out beyond just nat gas, but also to include oil now.
Yeah, first of all, there's a lot of very high quality Western Canadian companies that are trading at deep discounts. I mean, I think the impact of the tariffs has already been more than fully priced into the stocks. And a couple things to remember, again, knowing their production mix and knowing where they sell their production. Remember, the tariffs only impact what they sell into the U.S. So very few of them sell their natural gas directly into the U.S. And then almost none of their NGLs go into the U.S. So of the oil that goes into, let's say the tariff stays at 10%, I'm discounting their revenues by like 5%. So it's not that big of a deal. And some of these stocks have been discounted 20, 30, 40%. I mean, they're really, really cheap. And they're still very profitable if WTI averages 65 and the Canadian gas price averages 250 Canadian, I'm talking Canadian dollars, you're still talking extremely profitable companies. I mean, I like Hemisphere Energy, and it produces almost no gas. The gas it produces, it just uses that to power their pumps out in the oil field. So their revenues are more than 99% oil related, and it's heavy oil, and U.S. needs that heavy oil. But because the Canadian dollar has gone down a little bit in value, I was talking to Don Simmons, the CEO, the other day. He goes, frankly, our oil price in Canadian dollars in the second half is probably going to be higher than what we expected. So it looks good. And I like these companies not just because of what they're doing right now. Hemisphere's got a development going over in Western Saskatchewan that has the potential to triple the company's production. I mean, it's really a high potential deal. I like In-Play Oil. The reason I like In-Play is they just announced, and they will be closing in April, a truly transformative acquisition that is going to more than double their production and double or even triple their development drilling inventory. And they produce a lot of gas too. I would say their production is maybe 65% oil and 40% natural gas and NGLs, which they are not going to be paying much of a tariff on. And that one looks really good. And the impact of that truly transformative acquisition, I've been following this company since it was formed, like 10 years. And I know the CEO and I know their team really well, and they're really excited about that deal. It's going to be a great deal for the company. And they pay a really nice dividend. And they're committed to keep paying their monthly dividends. So In-Play, I like Surge Energy because it pays monthly dividends. And, their dividend yield is like 11-12% based on the current share price.
All right. Dan, a lot of opportunities out there in the energy sector, especially if oil can rebound and get above 70, even make a run even higher than that. The oil price has been the one thing I think holding back some of these companies, but again, natural gas, that has done well. We are still dealing with broadly a lot of, fear in these markets, so that can also hold back some of these equities.
Yeah, I'd just like to remind your listeners, if they send me an email to dmsteffens@comcast.net, we just recently published updated profiles on Antero, Coterra, EQT, Range Resources, Crescent Energy. We just recently updated our profiles on those. So if they send me an email, I'll be happy to send them our recent profile on those companies.
All right, there you go. I'll post Dan's email in the show notes. You can also email Shad or myself directly. Again, Dan Steffens, president of the Energy Prospectus Group. Click the link in the show notes on our website and podcast and on YouTube to follow along with Dan and what they're covering over at the Energy Prospectus Group. Everyone, thanks for tuning into this weekend show. Again, please go back, like, subscribe, comment on our YouTube page, on our podcast. That helps get the word out there of this show and helps us stay up to date with all of you. Thank you all for tuning in on this weekend show. We'll be back with you throughout the rest of the week. I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.